Hi, I'm Jason from Kaleido Loans. If you're watching this, I'm guessing you're either curious about buying your first home or starting to get serious about it. Maybe you're wondering if it's even possible in today's market, and you're not alone. Right now, the two biggest things holding first home buyers back are reduced borrowing power from high interest rates and the challenge of saving the deposit when rent and living costs keep rising. So in this video, I want to walk you through how first home buyers are getting around these two challenges. We'll go through what's working right now, what to avoid, and 5 practical steps that will make your journey less stressful and more successful. By the end of this, you'll have a much clearer idea of where you stand and what to focus on. And if you want help applying this to your situation, I'll show you how to book a free discovery call at the end. Now, let's start with the most common mistake I see first home buyers make. Trying to figure out everything in the beginning by themselves. They spend months Googling, reading comments on Facebook groups, asking friends and family for advice. There's nothing wrong with doing your own research. But the problem is, most of the advice out there is based on someone else's situation, not yours. Just because your friend needed a 20% deposit doesn't mean you do. Just because your cousin got rejected by a bank doesn't mean you will. Instead of guessing, your first step should always be speaking to a mortgage broker. We assess your situation, explain the policies that apply to you, and give you a clear plan so you're not flying blind. You can still research later on, but now you're validating what's relevant to you rather than exploring. Now, let's talk about the first issue many first home buyers face, the deposit barrier. This is when you have less than 10% deposit or you don't have the 20% deposit needed to avoid paying for expensive lender's mortgage insurance. This is one of the most common issues we help first home buyers with, and there's more than one way around it. The first and most well-known solution is using a guarantor. Usually your parents. This is where your parents use the equity in their property to support the loan that you need, so you don't have to pay lender's mortgage insurance, also known as LMI. One thing to note is that having a guarantor does not increase your borrowing capacity. The only thing it does is to help you avoid LMI and purchase with a deposit of 10% or less. But not everyone has that option. Or not everyone preferred to involve family for whatever personal reasons they have. If this is you, that's where the government's home guarantee scheme comes in to fill this gap. This government scheme allows you to buy with just a 5% deposit and no LMI. The government essentially acts as your guarantor. That can save you tens of thousands of dollars, and it means you don't have to wait years to save a full 20% deposit. However, there are eligibility criteria for this, such as your income threshold and purchase price threshold, amongst many others. Next is something most people don't know about: LMI waivers based on your occupation. This option is useful if you don't have or want your parents to be guarantors for your loan, and because you may not qualify for the home guarantee scheme I just mentioned because of your income or your purchase price exceeds the threshold or you don't meet other criteria. Certain jobs like healthcare workers, emergency services, legal and finance professionals can qualify for a waiver. That means you could buy with just a 5 to 10% deposit and still avoid LMI. But here's the catch. Not all banks offer this, and some banks won't tell you about it if this is not a policy that they have. So if you're a nurse or a teacher or a police officer, you might be eligible for this without even realizing it, unless you're working with a broker who knows where to look. Now, we have assisted clients where they were presented the option of paying thousands in LMI by their bank because they didn't have a 20% deposit, only to realize that their occupation actually qualifies for this waiver after speaking to us. Another strategy to solve a low deposit problem is purchasing at a price that enables you to avoid stamp duty, because stamp duty is a cost added on top of the property purchase price. So if you have to pay stamp duty, then you are not able to use all of your deposit towards the purchase price. In New South Wales, for example, you pay no stamp duty on properties up to $800,000 if you're a first home buyer. And even if your partner is not a first home buyer, you may still qualify for a portion of this benefit. Therefore, by purchasing a property up to $800,000, you will be saving over $30,000, which you can put towards the purchase price instead and increase your purchase budget. Other states have similar waivers or discounts, and some even apply them to homes up to $1 million, depending on the location and the type of property. Now, most good mortgage brokers will go through and explain all the government benefits you qualify for as a first home buyer. So make sure you take advantage of their knowledge, as they would have seen hundreds of similar cases and scenarios just like yours. If you're trying to maximize all of the government's first home buyer benefits, then buying a brand new property will help you do this. This is because there are state government grants specifically for brand new properties, where the government will give you a grant of $10,000 up to $30,000 depending on the state you're buying in. This is where the government will actually give you money rather than help you save or avoid paying for things. However, it is generally only limited to brand new properties, which have not been sold before. Typically, first home buyers needing to take advantage of this benefit will buy a property off the plan or buy a property that's just been completed. And you can combine this with other schemes like the first home guarantee and stamp duty waivers, helping you stretch your deposit even further. We always help our first home buyer clients maximize every single first home buyer benefit they qualify for, and create a strategy to help them take advantage of as many benefits as possible so they can purchase sooner. However, it's important to keep in mind that finance is about deposit and borrowing capacity. So the solutions I just mentioned will help you reduce amount of deposit, reduce the barrier to entry, but it doesn't help if you're lacking in borrowing capacity to get the loan that you need. So let's talk about borrowing capacity and how it's just as important as the amount of deposit you have. Some people come to us with a great deposit from gifts, inheritance, or years of saving, however they achieve that. But they still can't buy the property they want because their borrowing power is limited. This is often where things get frustrating, because borrowing power isn't just about how much you earn, it's about how the bank calculates how much you earn. So different banks use different formulas. One bank, for example, might approve you for a loan of $600,000. Another might approve you for $700,000. Now there's a $100,000 difference just based on how they calculate your income and your expenses, even though both banks are presented with the same set of financial information. For example, if you earn bonuses, commissions, or overtime, some banks will only count a portion of that income or none of it at all. This is because banks have their own individual credit policies, and some may be more conservative than others, which will affect your maximum borrowing capacity. Another example is if you work casually, or you're on a fixed term contract, or you're self-employed. Some banks will ignore your income entirely unless you meet very specific conditions, such as length of time in the industry or the length of time in your role. Now, unfortunately, a bank's credit policy is not advertised the same way as they advertise their interest rates. So the only way to find out if you're doing this yourself is having to speak to a bank directly. And even then, you may not know how your borrowing capacity is calculated because they simply give you a number without the reasoning behind it. Another often overlooked factor that can impact your borrowing capacity is your living expenses, childcare fees, private health insurance costs, private school fees, even strata levies on apartments, townhouses, and so forth. All of these are treated differently by each lender and can affect your maximum borrowing capacity with each bank. I've seen cases where someone has been knocked back by one bank and we got them approved for the full amount they needed with another, just because we understood how to navigate the bank's policies so we could find the bank that would be most favorable to their particular personal financial situation, so we can help them maximize their borrowing capacity to purchase the home they need. So again, using a broker means we can match you with a lender that works for your specific circumstances, while working with a bank only gives you one option, one set of lending policies, and if you don't fit into it, then that's just too bad. The next part I want to talk to you about is the 5 steps you should be taking to ensure your process of buying your first home is not a stressful experience, because finding the right property to buy is already stressful enough. Whenever I'm at a birthday party or gathering, once people know that I'm a mortgage broker and I do this for a living, the most commonly asked questions I get from first home buyers is how should they start the process if they are planning to buy a property. Now, I'm going to share the 5-step process that I tell every single person when they ask me this question. Step number 1. Speak to a mortgage broker. This is your starting point. A mortgage broker will help you understand where you are, what's possible, and what needs to happen to be in a position to buy. Not only will a mortgage broker answer all your questions, but the most valuable part of speaking to a mortgage broker is that they'll tell you what you should consider and what you should know. Like the cliche goes, you don't know what you don't know. So even if you're not ready to buy yet, a mortgage broker will give you a plan to get there. Avoid researching online by yourself as your very first step. Just like as I mentioned in the beginning, the starting point should always be a conversation with a professional, and then you can take the advice and information provided to do further research if you like. Step 2, get pre-approved. Can't stress this one enough. If you're browsing realestate.com.au on your phone during your commute, you're closer to buying than you think. Pre-approval is free. It doesn't lock you into anything, and it puts you in a position to act when the right property shows up, and you just never know when. Just like everything else in life, put in the effort in the beginning and get yourself pre-approved so when you do find the right property or it shows up unexpectedly, you would have done 80% of the work already, and in most cases, for the finance side, the only thing left will be getting the bank to complete a valuation on the property. Now, even if the pre-approval expires, with most banks, it can be renewed easily, and if it can't, banks don't change their policies every week. So you'll have greater confidence knowing the bank has reviewed, assessed, and accepted your proposed loan application previously. Step number 3, line up your solicitor or conveyancer. Don't wait until you find a property. You'll want someone ready to review contracts quickly. If you don't know who to use, ask us. We work with many great solicitors and conveyancers through the experience of our clients. It's also a good idea to ask for recommendations from friends and family who have had a good experience with their conveyancer or solicitor when they purchase their property. Now, you can make an inquiry to understand how they work, what their cost is, and have all this information ready so you can decide who you wish to use once you have found your potential property. Now, step number 4. Use your mortgage broker as a property coach. Mortgage brokers provide property reports, suburb data, share general advice from their previous client experiences to help you avoid traps or costly mistakes. Also, some properties are restricted, blacklisted by banks, so mortgage brokers will flag those risks before you get emotionally attached or put down a deposit. And it's important to remember that mortgage brokers are not just here to give you your borrowing capacity, your interest rate on the loan, and the amount of your repayment. Mortgage brokers do this every day, so make sure you take advantage of their expertise when they guide their customers through the property buying journey and providing insights to help you make informed decisions on what is potentially the biggest financial decision of your life so far. Step number 5, make your offer or bid at auction. Sounds pretty obvious, but this is the most emotional part of the journey. But if you've done the work in the first 4 steps, this part becomes a lot less stressful. At this point, the last thing you want to be doing is sorting out your pre-approval or finding your solicitor to review the contract. This is why I emphasize the importance of the first 4 steps, because buying a home doesn't need to be stressful and chaotic. By following the right steps in the order, you can remove a lot of that anxiety. Now, here's a bonus mindset tip before we get into some examples. When comparing rent and mortgage repayments, don't just look at the total figures in comparison. Yes, a mortgage might cost more per month because of the principal and interest repayment, but part of that repayment is money you're effectively paying back to yourself or owning your property. Rent is 100% gone. Mortgage repayments help you build ownership, or in other words, building up your savings in the property itself. And over time, your interest costs will drop. Rent only ever goes up. Now, let me give you a few quick examples of what we've seen and how we've helped our first home buyer clients. We recently saw a couple in their late 20s earning about $85,000 each. They had $40,000 in savings. They bought a $760,000 unit in Strathfield, New South Wales, which is a popular suburb with convenient public transport, popular schools, and great amenities. The average house price in Strathfield is $3.9 million. They did this by using the 5% low deposit government home guarantee scheme and saved several $1,000s in LMI. They knew this property would never be their forever home, but they knew where they wanted to live, so they understood their capacity and options and purchased what they could afford to get started. They plan to focus on paying down their mortgage in the next several years and eventually sell the property to help them upgrade into their forever home. To put into some perspective, if they purchased this property with a 20% deposit, they would have needed to save up to $152,000, which would have taken them several years while they continue to pay rent while property prices continue to increase. Another example is a family with 2 kids buying an $800,000 unit in Western Sydney. They had $80,000 saved, which is not bad. And because they're purchasing at $800,000 and they're both first home buyers, they didn't need to pay a single cent in stamp duty, which for a non-first home buyer would have cost $30,500. This means they can use their full $80,000 savings towards the purchase price and would need a loan of $720,000. They approached their bank that they have always banked with and was told that their maximum borrowing capacity was only $670,000 because the husband's income included annual bonuses, and in most recent bonus was more than the year before. So the bank is going to take the average of the last 2 years. We apply with a bank that will accept the customer's most recent year's bonus, even though it was higher, and manage to increase his borrowing capacity by $50,000 to $720,000, which enabled them to purchase their home. Additionally, they didn't have to pay any mortgage insurance because one of them was a nurse, and based on the bank that we selected had a policy to waive the lender's mortgage insurance for nurses. This saved them another $17,700 in LMI. That's a total of $48,200 saved in their process of buying their first property. Now, example number 3, we had a Queensland couple wanting to maximize the government grants available to them to support their low deposit. They decided to buy a brand new property off the plan because they wanted to get into the market as soon as possible and secure a purchase price before it keeps increasing. They bought a $700,000 property, which means they would receive a $30,000 first homeowners grant from the Queensland government at settlement, and they saved $17,350 in stamp duty as well. While the property is being built, they're working hard on saving towards a home so they can reduce how much they need to borrow in the future. Now, I know not everyone's in these situations, but even if you're not ready to buy right now, the most important thing is to find out where you are and what you need to do to be in a position to buy. We'll help you understand whether the challenge is deposit, borrowing capacity, or both, and give you a clear plan to work through it. I strongly encourage you to speak to us or any other mortgage broker to make sure you clearly understand this. Otherwise, you'll be chasing a target you cannot see. If you want help figuring that out, the next step is simple. Book a free discovery call. No pressure, no jargon, just clarity. Thanks for watching, and I hope this helped you move one step closer to your very first home.